Imagine if you could look at a gold price chart and instantly understand where the market might move next. Not guess, not hope, but actually read the story hidden inside the price. Because here's the truth, most beginners don't realize. Gold doesn't move randomly. Every spike, every drop, every sideways move leaves clues. And once you learn how to read those clues, the chart stops looking confusing and starts looking predictable. In today's video, I'm going to show you how to read gold price prediction charts, step by step, in the simplest way possible, and how traders actually forecast where gold could move next. If you've ever felt lost staring at candlesticks, trends, or indicators, stay with me, because by the end of this video, charts will make a lot more sense. And before we go deeper, if you want simple and powerful trading insights like this every week, make sure you like this video and subscribe to Forex Trading Rocket Signal. It really helps the channel grow and keeps you updated with practical trading knowledge you can actually use. Now let me tell you something interesting. A few years ago, I remember watching gold move sharply up in just a few days. News channels were calling it unexpected. Social media traders were shocked, but experienced chart readers, they were not surprised at all. Why? Because the chart had already been warning them. The trend, the support levels and momentum signals were all lining up. The move looked sudden to beginners, but predictable to trained eyes. And that's exactly what we want for you, to see what others missed. Let's start with the most important mindset. A gold price chart is not just lines and candles, tone. It's a visual record of human emotion, fear, greed, uncertainty, confidence. When investors feel unsafe in the global economy, they run toward gold. When they feel confident, they move money elsewhere. So every price movement reflects real decisions made by millions of people. Your job is simply to learn how to read that behavior. The first thing you need to understand is trend direction. Before predicting anything, you must know whether gold is generally moving up, down, or sideways. This sounds simple, but many traders ignore it and jump straight into indicators. Always. Zoom out first, look at the bigger picture. If gold has been making higher highs and higher lows, that's an uptrend. Buyers are in control. If it keeps making lower highs and lower lows, that's a downtrend. Sellers are in control. If price is bouncing between the same levels again and again, that's a range, meaning the market is undecided. Think of trend like the current in a river. Swimming with it is easier than fighting against it. When gold is trending upward, prediction becomes easier because probability favors continued strength unless something major changes. Now, let's talk about support and resistance, the foundation of price prediction. Support is a level where gold repeatedly stops falling and starts rising. Resistance is where it repeatedly stops rising and starts falling. These levels exist because traders remember them. If gold bounced from a price before, many traders expect it to bounce again. This shared expectation creates real market reactions. When price approaches support, buyers often step in. When it approaches resistance, sellers become active. And here's the powerful part. When support breaks, it often becomes resistance. When resistance breaks, it often becomes support. This role reversal is one of the most reliable clues in chart reading. Now imagine gold is approaching a strong resistance level that has rejected price 3 times before. If price reaches that level again, you already know tension is building. Either it will reject again or break strongly. Both outcomes are tradable and predictable, because you understand the structure. Next, we need to understand candlestick behavior. Candlesticks are like the language gold uses to speak to you. A long bullish candle shows strong buying pressure. A long bearish candle shows strong selling pressure. Small candles show hesitation. Long wicks show rejection, meaning price tried to go somewhere but failed. For example, if gold falls toward support and suddenly forms candles with long lower wicks, that means sellers pushed price down, but buyers forced it back up. That's hidden strength. On the other hand, if gold reaches resistance and forms candles with long upper wicks, buyers tried to push higher, but sellers blocked them. That's weakness. You don't need to memorize dozens of patterns. Just ask one simple question: who is winning, buyers or sellers? Now, let's bring momentum into the picture. Momentum indicators help you measure the strength behind price movement. One of the most useful concepts here is divergence. This happens when price moves in one direction, but momentum weakens. For example, gold makes a new high, but momentum indicator makes a lower high. That's a warning sign. It means buying pressure is fading, even though price is rising. Very often, reversals follow. Momentum tells you whether a move is healthy or tired. Another powerful forecasting tool is trend lines. A trend line connects important highs or lows to show direction. But more importantly, it shows where price might react in the future. When gold respects a trend line multiple times, it becomes meaningful. If price breaks that trend line strongly, it often signals a shift in direction. Think of a trend line as a boundary of control. As long as price respects it, the current trend remains strong. Once broken, control may be changing hands. Now, let's talk about something many traders forget: time frames. Gold can be bullish on a daily chart, but bearish on a 1-hour chart. Both can be true at the same time. That's why professional traders always check multiple time frames. The higher time frame shows the main direction. The lower time frame helps with entry timing. If daily trend is bullish but short-term price pulls back to support, that pullback might be a buying opportunity rather than a trend reversal. This is how forecasting becomes structured rather than emotional. But gold doesn't move based only on charts. Fundamental forces play a huge role too. Inflation expectations, interest rates, economic uncertainty, and currency strength, especially the US dollar, all influence gold. When inflation rises, gold often rises because investors want protection. When interest rates increase sharply, gold can fall because holding cash becomes more attractive. When global fear increases, gold becomes a safe haven. So the smartest prediction approach combines technical structure with fundamental context. Charts show bullish momentum and fundamentals support gold demand. Probability becomes stronger. Another critical but underrated factor is patience. Prediction does not mean forcing trades. It means waiting for confirmation. Many beginners predict too early. They see gold near support and instantly buy. Professionals wait to see if buyers actually defend that level. Reaction is more important than location. Let me share a simple forecasting process you can follow every time you open a gold chart. First, identify the overall trend. Second, mark major support and resistance zones. Third, observe candlestick behavior near those zones. Fourth, check momentum strength or weakness. Fifth, consider the broader economic environment. And finally, wait for confirmation before acting. If all these elements align, your prediction is no longer a guess. It becomes a probability-based decision. Now let's talk about risk, because even the best prediction can fail. Markets are driven by uncertainty. Unexpected news can override technical signals. That's why risk management is not optional. Always know where your prediction becomes invalid. If gold breaks clearly below a support, you expect it to hold, accept it quickly. Being wrong is normal. Staying wrong is expensive. Professional traders don't aim to be right every time. They aim to be disciplined every time. One of the biggest mistakes new traders make is overloading charts with indicators. They think more tools mean more accuracy. In reality, clarity creates accuracy. A clean chart with trend, levels, and price behavior is often more powerful than 10 indicators flashing different signals. Tell a day. Another common mistake is emotional prediction. Wanting gold to go up because you bought or wanting it to fall because you sold is not analysis, it's attachment. The chart does not care about personal opinions. It only reflects collective market behavior. The more neutral you become, the clearer your predictions will be. Let me bring this all together with a simple mental image. Imagine gold is climbing a staircase. Each step higher forms support. Small pauses happen along the way. Occasionally, price pulls back slightly, but as long as it holds previous steps, the climb continues. Your job is to identify the staircase, not panic during normal pauses, and recognize when a step truly breaks. That's the difference between reacting emotionally and forecasting intelligently. As you practice reading gold price charts, something amazing happens. You stop chasing price. You start anticipating it. You stop reacting to news headlines. You start watching structure. You stop feeling confused. You start feeling prepared. And that confidence is what separates random trading from professional thinking. If you found this explanation helpful and you want more practical trading education like this, remember to stay connected with Forex Trading Rocket Signal, where we break down market behavior in a way that's simple, clear, and actionable. Before we finish, I want to hear from you. When you look at gold charts, what confuses you the most? Trend, direction, support and resistance, or indicators? Drop your answer in the comments, because your question might become our next video topic. And if you know someone who wants to understand gold trading, but feels overwhelmed by charts, share this video with them. Learning becomes easier when the right concepts are explained the right way. Thanks for watching. Keep learning, keep observing the charts, and I'll see you in the next video.